Hello, how you doing? Stephen Fallon here, Future Proof Finance, number 7 of 10, talking about pensions. This week we're talking about fees. What I'm going to do is I'm going to go into what happened in the UK in 2013. It was called the Retail Distribution Review, basically RDR. And what this did was it stripped away the large upfront commission. Now, so I'll paint a picture of what happened in the UK. An advisor would predominantly lean towards a particular company for the simple reason that the company gave the advisor a kickback for doing business with them. Okay, now that still happens here, and because of what happened, because they've changed that in the UK and they've stripped that away, they've basically forced advisors into an area where they charge either a fee or a percentage of portfolio, basically an assets under management charge, for want of a better term. And on the back of that, because this has happened in the UK, it's created a bit of fear across the water here, and any advisors with a bit of foresight, or a bit of a good horizon, will actually look at what's happened there and think, actually that could happen here, so I might as well change my business model. We still have excuse me, we still have a scenario here in Ireland where life assurance companies will pay you a large commission. Some life assurance companies pay better than others, and as a consequence of that forces, it doesn't force advisors, but it makes it very attractive for an advisor to place the business with them as opposed to this one. By following the UK model and working on a fee or assets under management portfolio charge, basically a transparent way of doing business, because you're talking to someone, you can see everything there in front of you, so you know exactly what you're dealing with, exactly what it's costing, and exactly what everything's costing. So if you're doing business that way with someone, more there'll be less bias. There won't be a bias. It'll be a case of actually what's best for you, where's the best place to put this, and so on. Now, we still have a scenario of RDR actually hasn't come over here. It may or may not. We have a different structure here. There's a smaller, what's the population here? 5-6 million. There's 10 times that in the UK. So it's a bigger market. And when this happened in the UK, there was regulation brought into the level of education with the advisors over there, and it basically removed, I think, somewhere in between 20 and 25% of the market left. So you'd a smaller number of advisors out there, looking after clients. And also another backlash of it was the smaller. So if you think of a smaller client, someone who's basically starting out, over in the UK now, they have a problem with that because they're not getting any advice. So it's I suppose it's finding a happy medium. Currently, you have the option, like if you're talking to an advisor, ask the question. You can basically you can work on the traditional model, but you want to do it in a transparent way. You want to know what the advisor is getting paid on your money, depending on whatever life company. So you need to see all that. You need to see what he's getting paid, what the commission are, and the rest of it. Like ultimately, going back, someone would place business. Let's say you had a fund of 50,000 and you decided to move it from A to B, and the advisor was advising you to move it from A to B. He would get a percentage of that, and ultimately it would look like it wasn't costing you anything. Your management charge is this, and 100% of the money is going in. There will be penalties on the movement of that in a period of a couple of years. But on the basis that the advisor is getting paid from the life company, like let's call a spade a spade. You're paying the advisor in a roundabout way, because ultimately that money is being taken off you and then they're giving it to the advisor. There's a kind of a misconception that the life assurance company is paying the advisor. They're paying the advisor with your money. They're not basically giving the advisor their own money and then going, look, we're happy to do business, we'll get it off you over the next 20 years. Life assurance companies don't think they're going to get the money off you the next 20 years. They wouldn't sew in penalties. They wouldn't sew in surrender penalties if that was the case. Look, there's a myriad of these fees. Ultimately, what you want to do is when you're talking to someone, you want to reduce them down as much as possible. But at the same time, you want to find a happy medium, because if you strip the fees right down to where you're paying little or nothing, you're going to get little or no advice. So you have to find a happy medium. Like, what's cheap, you kind of get what you pay for. There's a number of fees in some of the older pension products. If you predate 1990, some of them pension products have massive fees. So any of them older pensions, they need to be looked at. You need to see if you can actually update that, strip some of the fees away. But it has to be done. It has to be done with some care and attention, for the simple reason that if there's massive penalties, it might need to be just left alone, and stop and start a new structure rather than carrying on. If you have any more questions on relation to fees or any of this sort of stuff, come back to me. The company is futureprooffinance.ie. Talk to you all again soon. Bye bye.